Hey guys, this video is for PFIN Chapter 9. I'm just going to do a quick review of the chapter, quick summary. Before I get started on that, just let you know my plan is to make one video per day. So I have 4 different classes, and the plan is to try and get all my chapters done, like review videos for each class done by May 9th, so they'll all be done at least a week before the deadline for assignments and stuff. One other thing is for this class for personal finance, Connect has quite a few good videos. I'll just share the screen here for you and show you. So this is the videos for Connect for PFIN. So we're starting chapter 9. You can watch these videos if you want. I've left a link for them on Moodle. Yeah, I think that's it for announcements. So I'll start chapter 9 here. Oh, other than that, again, just reach out by email if you have any questions about the chapter, or even when it comes to the YouTube videos, feel free to subscribe to the channel so that you get notifications. And also, as I've said in other videos, it's important that you're keeping in touch with us. So you can even just comment on the video, just saying that you watched it, or give a thumbs up or whatever. Actually, probably better if you comment, so then I know who it is. Just yeah, and then I can document that in our spreadsheet to make sure that you're keeping up. But anyways, chapter 9 for PFIN is continuing with insurance, but it's looking at life, health, and disability insurance. So another thing that's something that a lot of people are probably at least generally familiar with, maybe not super knowledgeable on, but most people are familiar with, like health insurance and life insurance. Life insurance is obtained by purchasing a policy with the insurance company promising to pay a lump sum to the person, which is the beneficiary at the time of the insured's death, or sometimes while they're still alive. So that's what life insurance is for. It's if you basically insurance in case you die, for the most part. Some policies, money is paid to the policyholder if he or she is still alive at a future date. So sometimes there is a payment amount at the end of a specified term, and the company makes a promise to pay in exchange for the payment of a premium. So anytime you're having insurance, you're typically going to be paying premiums. So whether that's health insurance or life insurance or whatever. So the purpose of life insurance is to protect someone who depends on you from financial loss related to your death. And those proceeds, meaning the money coming from the insurance policy, may be used to pay off a home mortgage or other debts at the time of death. Provide lump sum payments through an endowment to children when they reach a specific age. So maybe once they reach the age of 18, go to university or something. Provide an education or income for your children, make charitable bequests upon your death, or provide a retirement income. So basically, life insurance, the main reason you're taking it out is, it's not for you. It's based on you, but it would be to help your dependents if you die. Because, you may have, a mortgage outstanding. So if you have dependents and you're the one working and you're making mortgage payments, if you die, how are your kids or your spouse going to make the mortgage payments without your income? Or how are the kids going to be able to go to university and support themselves if you die when you're the one supporting them, kind of thing. So that's where life insurance comes into place. The proceeds may also be used to pay off estate debts, time of death, provide education, income for survivors, and that was kind of included already. So principle of life insurance, looking at like premiums and how they're determining the cost and value. Mortality tables provide odds on your dying based on your age and sex. So that's page 287, 288. You can take a closer look in your textbook if you want. It's just kind of showing the breakdown. Like obviously the older you get, the more likely you are to die. Someone in their 80s has a higher reasonable expectation that they'll die compared to someone in their 20s or 30s, which which will make your insurance premiums higher. Your premium is based on your life expectancy and the projections for the payouts for the person who dies, and adjustable for factors that increase, decrease an individual's risk, or raise administration fees for the company. So I'm sure you guys are somewhat familiar with that too. Like certain people have to pay higher premiums for health insurance or life insurance because of their situation. Maybe if they're higher risk for health issues or working a riskier job or something, and they might have to pay higher premiums. So next is determining if you need life insurance and the needs of your life insurance. So do you have people you need to protect financially, and do you have a partner who works? So this is really important to consider. Maybe not everyone needs life insurance, or at least if you are getting it, you know, how much you need and what's included in it should vary a lot depending on your situation. For myself, I've never gotten into life insurance because I don't have dependents. Like if I die, whatever. I don't mean whatever, but I don't have kids that are gonna go hungry or whatever, or I don't have car payments or mortgage payments outstanding that my kids would have to pay, or even like if I had a stay-at-home wife or something who's looking after kids and not working, then how is she going to afford to pay for everything when I've been the one earning? So because I'm not really in that situation, I'm only looking after myself and I don't have any debts or anything. For me, life insurance isn't as important. But for someone who's like the primary earner in their family and has many dependents, that's when it would become more important. Next thing is, what are your objectives for life insurance? So how much money do you want to leave your dependent should you die today? Are you considering funeral costs? Like that would be maybe the thing for me. Although I would just say, just dispose of my body as cheaply as possible. I don't care. When you retire, what income do you need? And how much will you be able to pay for your insurance program? So that's another thing. Like, even if you feel like you want a really good insurance policy, maybe you just can't afford to pay really high premiums for that very extensive life insurance policy. Now this slide is determining how much you want to be insured for. One common method for determining that is this 70% method. So it's saying 70% of your salary for 7 years while the family adjusts. So if your current income is $100,000 per year, times that by 7, that's $700,000. Times by 70% or 0.7 is what, $490,000. So that assumes a typical family with no liquid assets available that would otherwise reduce your life insurance needs. So that this method used to calculate how much you'll want is just kind of a generic ratio, I guess, saying, you know, your family would get 70% of your income for 7 years that they have time to adjust to the loss of their family member that was potentially the provider, I guess. The family need method, this is more thorough than the first method because it also considers employer provided insurance, social security benefits, and income and assets. So it's looking at more of an individual breakdown as far as like what other forms of income you'll have and what other costs you may have. Just a image from your textbook here, looking at the family need method. So just kind of a worksheet here, looking at certain things like funeral expenses, income taxes, things like that, children's education. So this is going to be a more specific number rather than that just like generic 70% 7-7 method. Next slide here is just breaking down the different types of life insurance. So term life insurance, that's protecting you for a specific period of time. Can have things like renewability option, means that at the end of the term you can renew the policy without having a physical. So typically insurance policies, especially if they're just for individuals, not through groups, you may have to have a physical to determine the state of your health. Because as I said before, premiums will be often dependent on your state of health. You know, so people with a lot of health conditions may have to pay higher premiums. Conversion option, which allows you to change your policy from term to whole life without a physical. So that's just going from this term life insurance to whole life insurance. Term to 100 is another form, remains in effect to the age of 100. Level premium costs significantly less than permanent insurance. So level premium costs, that just means when your premiums are level throughout the lifetime of your policy. So it's whatever, $100 or maybe less than that, $20 per month every month for the whole duration. They're not going up and down. Whereas typically the older you are, the higher your insurance premiums would be. But with this type of policy, you can get it so that they're level. So maybe you're overpaying when you're younger and then you're underpaying when you're older. And then decreasing term insurance, premium stays the same, but the amount of coverage decreases as you age. So there's a bunch of different forms here. Permanent life insurance is another form. Purchase to cover lifelong needs. Financial expenses, supplementing a survivor's income. So if your husband or wife dies, this policy may allow them to receive more income. Also, with these permanent life insurance policies have level premiums, again, same over the lifetime of the policy, which means higher paid in early years and offset increased costs in later years. I'm just gonna plug this computer in. Okay. Continuing with types of life insurance. So upon death, face value or policy paid out to named beneficiary. Permanent life insurance has the following variables. So what it's saying here, upon death, so if the person taking out the insurance policy dies, the face value of the policy is paid out to the named beneficiary. So the beneficiary is typically going to be your partner, your husband, your wife, or your kids, your dependents. With this type of policy, that whole life one that we first, pays specific premiums as long as he or she is alive, and pays a stipulated sum to the beneficiary upon death. So that's a like predetermined amount of money to the beneficiary upon death. So maybe that's whatever, $500,000 to the husband or wife of the person who's taking out the policy. Has a cash value which is paid out if policy is given up. So if you decide to give up the policy, there will be a cash value paid out. The next one is universal life policy. Combines term insurance and investment elements. Can pay variable premium amounts. More flexible with death benefits, and can change a premium without changing coverage. The last two there, variable life policy. Premiums are guaranteed. Endowment life insurance, coverage from beginning of contract to maturity, guarantees payment of specific sum even if insured is still alive. So there's a lot of different like minor details between these different policies. You can read the textbook if you want a little more detail on them. Let's see. Continuing here with types of life insurance, consider the following factors when pricing life insurance premium. So the amount of the insurance meaning like how much are you going to be paid out, or is your beneficiary going to be paid out in the case of death? Your health class, your age, your gender, marital status, occupation, recreation. So all these things can be factors that play into how much insurance you want and also the premiums you're going to have to pay. You know, so as I said before, like older people are typically going to have higher premiums. Maybe people in certain occupations might be higher risk and therefore have higher premiums. Health, if you have some serious underlying health conditions, you'd be more at risk. You'd be more likely to die, I guess, and need to pay more higher premiums for your life insurance. Another form of life insurance. Now we've talked about more from like individual basis or certain structures of life insurance, but this is like approach to getting it. Group life insurance, so that's term insurance often provided by the employer, and no physical is required. So you can get these forms of life insurance that we've talked about, but oftentimes they'll be through the method of group life insurance, where as it says here, the employer is providing it, which is very common. I think even at SIIT we have, well, I know for sure we have group insurance, so I think we have some life insurance included there, and no physical is required compared to if you're going to go for one of these other types of life insurance policies just on your own, not in the group form. You most likely would need a physical. Credit life insurance, so that's just debt is paid off if you die. Basically, it's credit insurance in the case of death, so for a form of life insurance. So if you have outstanding student loans or car loans or mortgage or line of credit or whatever types of loans, you can get credit life insurance that will pay off your debt in the case of death, so that your dependents aren't responsible for that. Also protects the lender in the event that you die. Like lenders, you know, they want to get their money back. So if you die, they can't get their money back, but with this type of insurance, it would pay them back. So here's just a table, page 293 in your textbook. You can look a little more closely. This is just a better breakdown, as I was talking about before, like difference between whole life, universal life, term to 100, and regular term life insurance. You can just see the differences between period of coverage, premiums, cash values, things like that. So feel free to look into that a little bit more. I don't want to go over it in too much detail. So this is what I was talking about earlier too, is your premium costs and your age, where term life insurance premiums are going to go up as you get older, whereas with the permanent life insurance, as I mentioned before, like they'll have the level premiums where you're paying the same amount regardless of your age. So it just smooths it out. So here, as I said, like younger, you're overpaying, and when you're older, you're underpaying. Some important provisions in a life insurance contract: naming your beneficiary, so determining who benefits from your life insurance if you actually die, and then contingent beneficiaries, meaning dependent, like a synonym, or not synonym, different meaning of dependent. I mean, like where it depends on how you die or when you die. These beneficiaries are dependent on that. So, you know, for most people, as I said, that would be your kids or your husband or your wife or your parents or something like that. Other provisions would be length of grace period. So we've talked about grace period for credit cards, but this is late payments for your premiums. You know, typically you'd be paying monthly premiums. So usually 28 to 31 days, meaning if you don't pay within that time, it's okay. But if you go beyond there, they may cancel your life insurance. Reinstatement of a lapsed policy if it has not been turned into cash. Non-forfeiture clause prevents the forfeiture of future benefits if you drop the policy. So that just meaning if you decide to discontinue the policy, having one of these types of provisions called a non-forfeiture clause prevents forfeiture of the benefits. So of whatever cash you were supposed to get, you don't have to forfeit it if you have one of those clauses. Some other provisions, incontestability clause stipulates that after the policy has been in effect for a period of time, the company cannot dispute its validity. Suicide clause. So with that, I guess during the first 2 years, suicide does not count as a form of death in the sense that, well, I mean, it counts as a form of death, but it doesn't create a reason to be paid out in the same way other like accidental death would, or death from illness. But with that suicide clause, death benefit equals the amount of premium paid. So I believe that for many policies after 2 years, even if you die of suicide, it does pay out the full amounts as in the same way that you would if you died from accidental death or whatever. But for the first 2 years, the death benefit equals the amount of premium paid, meaning if you're paying a premium of $20 per month, you would just get that back, or your beneficiary would get that back, I guess, which isn't much money. But I mean, that's for obvious reasons. People could take out a $3 million insurance insurance policy that covers suicide and then just commit suicide, and then their beneficiaries get $3 million or something. So yeah. Next thing, automatic premium loan uses the cash value to pay the premium if you do not pay it. So meaning you have kind of like a built up cash value for your policy, and if you don't pay your premiums, it'll just apply that accumulated cash value towards your premiums. And then misstatement of age provision, if people are like lying about their age, will pay benefits premium that would have bought if age were correct. So it's just going to like revise the policy to make it appropriate for your actual age if you've misstated your age. Next thing is a rider to a policy. A rider is just like a modification or an amendment or additional information. So it modifies by adding or excluding conditions or altering benefits, things like waiver premium, disability benefit, accidental death benefit, a double indemnity, just meaning double the insurance value, terminal illness, joint loss to die, so just some other things regarding to rider. So when it comes to now buying life insurance, look at your present and future sources of income, savings, group life insurance, group annuities, and government benefits. So want to take those all into consideration. Maybe you don't need a life insurance policy if you already have, you know, good future sources of income and group life insurance through your work, government benefits like CPP, EI, things like that. And then determine from whom you want to buy your policy. So looking at private and public sources, looking at an insurance company's ratings, talking to other people maybe that have bought insurance through them. Do you want to go directly to an agent or a broker? Or directly to an insurer or a broker. Compare policy costs, which are affected by companies' cost of doing business, return on their investment, mortality rate among policyholders. So, you know, if one insurance company has a really high mortality rate of policyholders, their premiums are probably going to go up because they've been having to pay out a lot of money. Features of the policy, obviously, is a very important thing to consider when you're buying one. Competition among companies. So continue with buying life insurance. Steps involved in obtaining and examining a policy include obviously starting out here, submitting an application to the company. So you can probably even do that online where you just apply for life insurance, containing your personal information and medical history. As I said before, some, especially individual plans, may require a physical medical examination. Just some other steps here, read every word of the contract, get full explanation of terms and provisions. Typically, you can cancel the policy within the first 10 days without any penalty. And then just make copies for lawyers and beneficiaries. You know, it's good if you're taking out an insurance policy and your kids are your beneficiaries, it's maybe good to have a copy for them that's available so that they can look into it. And especially if in the event that you do pass away, then they have access to that information and what the policy covers. Choosing the settlement options. So settlement option meaning like what actually happens if whoever the policy holder actually dies. Is it a lump sum payment? That's the most common form. So if that policy holder dies, a lump sum payment would mean they're paid out whatever the insurance policy is worth. So maybe they get a one-time payment of $2 million to the beneficiary. That might be limited installment plans, so in equal installments for a specific number of years after your death. So maybe your beneficiary, rather than getting a lump sum of $2 million at one time, they're getting $2 million paid out over the course of 20 years. Life income option, so payments to the beneficiary for life. So this is a little bit different than this past one, where maybe it's paying them whatever, $10,000 per year for the rest of their life. So that would depend. Are they going to live for 5 years? Or are they going to live for 60 more years? So which one is best really depends on your situation. You know, obviously if your dependents or the policy holders, I don't want to keep on talking about you as if you're going to die, but the policy holders' kids are very young, maybe it's better to have a life income option where they'll be taken care of for life rather than a lump sum payment. And then the next one, there's proceeds left with the company. So meaning that that value of the insurance policy is left with the company and just pays interest to the beneficiary. So maybe that $2 million stays with the company rather than being paid out, like with the insurance company, rather than being paid out, and all the interest earned on it is being regularly paid out to the beneficiary. So it would be a smaller amount, but they'd be getting regular interest. Next thing, switching policies. Consumers lose millions because they don't hold cash life policies long enough to be purchased, or they purchase the wrong policy. You should switch if benefits exceed costs of getting another physical and paying policy setup costs. Yeah, so sometimes it makes sense to switch policies, but you have to consider that cost benefit analysis and determining if you can get provisions you want by switching to a different policy. Next thing here is looking at health insurance now, moving off of life insurance. So most basic medical procedures are provided under provincial government healthcare plans. So for here in Saskatchewan and in Canada, we don't really need health insurance for a lot of basic stuff. Health services are provided to us through our taxes. Canadians need supplemental coverage, however, though, for things like cosmetic surgery, prescription drugs, vision, and dental care, right? So we can go to the doctor for free for x-rays or whatever, but if we need to go to the dentist, that's not covered under our provincial or federal health care. Same thing with vision. If you need an eye exam, it's not covered under our taxes. Prescription drugs as well. So you may want supplemental coverage, supplemental health coverage to go beyond what the Canadian and Saskatchewan government provide. And then healthcare costs outside of Canada can be very high and may not be covered by provincial plans. So if you travel a lot, or if you're abroad for some reason, you may want to have some supplemental coverage just in case. If you're in the United States, where healthcare can be expensive at times, the coverage you have in Canada may not cover that, so you might want supplemental. The first type of health insurance, or I should say method of obtaining it, would be through group health insurance. So 65% of all health insurance is sold as group plans. This, again, just like usually through employers. So employer-sponsored employee may pay part of the cost. Yeah, this is very typical. Most employers offer health insurance, and typically they will pay the majority of it, and employee will pay part of it. It really depends. There's a lot of different agreements set up. Covers you and immediate family. So I'm sure most people listening to this video have probably worked somewhere where they had some group health insurance, and yeah, if you have dependents, it should apply to them. So that will cover things possibly like dental and chiropractic and optometrist, things like that. Seldom requires medical. That's true. Like, I've had many group health insurance policies before, and I've never had to do a medical. And then the next method of getting it would be individual health insurance. So just like we talked about with life insurance, covers one person or a family, not offered through a company, through your employer, and can be tailored to your particular needs. That type of method of getting health insurance may be more likely to require a medical examination. The next thing is disability income insurance. So that protects your most valuable asset, your ability to earn an income. So this is a form of insurance that's going to cover you in the event of if you become disabled. Provides payment to replace income when an insured person is unable to work. So a few details on that. Yeah, there's different forms, just like life insurance. Skip through that a little bit. More information on disability insurance. There may be a waiting or elimination period. So if you become disabled, there may be a long period before you can actually start receiving money, and the longer the waiting period, the lower the premium. Want to consider the duration of benefits, the amount of benefits, accident and sickness coverage, and guaranteed renewability. Yeah, just some other elements to the insurance policy to consider. You know, some are going to have a very different duration of benefits. Maybe some it's 1 year, maybe others it's for life. So if you become disabled and you can't work anymore, you're probably going to want a policy that's going to continue to pay you for the rest of your life and pay you an amount that you can actually live off of. And yeah, have guaranteed renewability so that you won't be left without the policy after a certain amount of time. Sources of disability income could be from employer. The employer may set up that insurance, could be a private company you've gone to, or public. So even with the government of Canada and provincial governments, we have employment insurance that can cover disability issues, although it's shorter term. Like, that's not going to pay you out. If you get a serious disability, it's not going to pay you for the rest of your life. If you're alive for 40 or 50 more years, it's short term. CPP, the same thing. It's smaller amounts and shorter term. So you definitely want to supplement with that. Workers' compensation and short and long-term welfare. Next thing, there's critical illness insurance. So if you become critically ill, meaning serious illnesses like cancer, heart disease, stroke, this type of insurance provides money for care if you are diagnosed with a serious illness or condition. The difference between this and life insurance is this pays you while you're alive. It's like, just because you get one of these conditions doesn't mean you're going to die, but it may take you away from your regular lifestyle. It may create more costs. It may prevent you from working. So this type of policy will pay you while you're still alive, tax-free lump sum within 30 days of being diagnosed. So meaning if you get diagnosed with cancer, having critical illness insurance would pay you out a lump sum within 30 days of being diagnosed. Most serious illnesses are not only treatable but curable, but costs are very high. So you may have to undergo for cancer, treatments that could be expensive, especially if you have to travel to another city or something like that. Can be used to pay off other debts or take time off work. So yeah, if you're having regular expenses and you can no longer work because of that, this critical illness insurance may be able to cover those payments. And then some typical policy provisions include waiver of premiums and premium refunded to beneficiary upon death. So the next thing here is supplemental health insurance, which I've talked about a little bit already, but after considering health and disability coverage available from the government, employer, or other policies, you may decide to seek further coverage, especially if you only have like government insurance. It may not be enough to cover what you want and what you may need. And that's where you would want to get supplemental health insurance. So as I said, things like dental expenses. You may have live in Saskatchewan and get free healthcare or healthcare paid by your taxes. But as I said, it doesn't cover dental. So you may want to get supplemental health insurance to cover that, whether individually or through your employer. Vision care as well, right? Even if we go to the optometrist for an eye exam, we have to pay out of pocket. The government won't cover that. If you have an employer group plan, often they will cover some or most of that. But I've had policies before where they only cover up to maybe like $125. So I still have to pay a little bit extra out of my own pocket. Some other types of supplemental health insurance, health service insurance, so things like prescription drugs, travel insurance. So travel insurance if you have medical expenses outside of Canada, accidental death or dismemberment insurance, and long-term care insurance, providing care for long-term illness or disability. Some provisions in a health insurance policy. Eligibility would depend on things like age, marital status, dependency requirements, assigned benefits, internal limits. Internal limits being things like what is the maximum you can use for your health. Maybe that's $500 per person per year per practitioner, like $500 for massage, $500 for chiropractic, things like that. Co-payments, that's the amount the patient pays after the deductible. A lot of times, it might be a split, like an 80-20, where the insurance company is covering 80% of your dental and you're paying 20. consider other things like cancellation and termination. What are the options there? Yeah, kind of talked about this stuff already. Internal limits, deductibles as well, out-of-pocket limits. So some insurance policies will have an out-of-pocket limit, meaning that the policyholder might be only required to pay up to a maximum of $2,000 in the event that they need health insurance, and the rest will be covered by the company. So that would be a way of protecting yourself from having to pay too much out of your own pocket. But yeah, that's it for the chapter. This is just a graph at the end of the chapter, just looking at how much Canada spends on healthcare. So 2016 here. You can see it's been rising a whole lot compared to 1975. So yeah, that's it for chapter 9. So hopefully that helped a little bit. I know I just rushed through it, but I don't want to make a 3-hour video. Again, check out Connect and watch some of the videos from the textbook there for a little more explanation. And yeah, just reach out if you have any questions. And that's it.